Okay, guys, I will have tons of time at the end for Q&A. So if anyone has questions, feel free to keep dropping them in the chat. I'll get to all of them towards the end. But, for some of you, and we're going to record this and it's streaming on multiple platforms. And I know our community keeps growing. So for those of you who don't know me, let me take a minute to introduce myself. I'm Param. I'm a radiologist, Southern California. I built my own personal portfolio over 10 years. I became financially free. And when I realized how powerful real estate was as a vehicle in my financial freedom journey, I, went on to build Generational Wealth MD. Our community is now at 15,000 members, mostly physicians. And essentially, a lot of what we do is talk about investing in real estate specifically and helping people break down barriers to introducing real estate into their portfolio so they're building more resilient portfolios that are diversified. And then when we realized that the majority of members in our community wanted to invest passively in syndications, we created GW Capital. At this time, we're at over 1,500 doors and over 250 million in assets under management. And so that's been a journey. But when I start, what I usually like to do is I like to go ahead and first, I take a bigger picture view. Why are we doing this? Why is this so important to us? And what I've realized for me and why I'm so passionate about this is because of the power of generating meaningful passive income when you're using real estate as a vehicle, right? That's the biggest thing. That's what has been most important for me, and that's why we were doing what we're doing. And so, if you actually look at it, if someone is saving $10,000, needs $10,000 a month to get to financial freedom, and you're saving about $2,000 a month, it will take you 26 years to do it with a stock bond portfolio. It takes you about 12 years to do it when you're investing passively in real estate through syndication. And so it doesn't seem as powerful, but if you think about it, your returns are almost double across multiple market cycles. And that's why it's able to propel you. And same thing, if you then start deep diving and start getting more active, you can really shorten and compress those timelines. And that's why it's so important, right? It's because of the ability of real estate to allow you to buy back your time. And when we talk about state of the market, for some of you, it may seem a little more detailed than what you're used to, especially if you're beginning to invest in real estate. And so for those of you, I kind of wanted to remember why we do this, right? Why is this so important? Because if you look at ultra high net worth individuals, their portfolios, 50% of their portfolios are invested in equity, including real estate, right? And for most of us, and this was me even before I started really accelerating my investing in real estate. For most of us, it's mostly in, you have your equity in your primary home, which isn't really an investment because it isn't throwing out cash flow, but then it's mostly stocks and bonds, right? And so allowing us to make those shifts into real estate investing in other alternative assets, that's what this journey is about. That's what we do over here at Generational Wealth MD and GW Capital. And so we closed, Q1 was eventful. We closed on Dawson Forest. Thank you for all those of you who were with us in that deal. Again, it was a solid asset that we added to our portfolio. Distributions are expected in June. But in the meantime, Q1 has been very powerful for us behind the scenes because we've been doing a lot of underwriting. Every week, we're underwriting multiple deals. We're vetting multiple sponsors. We're looking at different asset classes. And the goal is, the vision for us with GW Capital has been to really give all of you more opportunities as we go along. And we're thinking 2024 is going to be a transformational year because we want to bring in different asset classes. We're really underwriting deals in very strong markets in the Sun Belt. So a lot of deals in Phoenix, deals in Charlotte, in North Carolina, a lot of deals in Texas. We've been really looking at multiple cities in Texas. We've been underwriting a lot of deals, and we want to start working with partners who are also vertically integrated, have a lot of control. So we're really trying to diversify. So we're giving you the ability to build a portfolio. And, a lot of what we do is also education. I'll be sharing a lot of resources for those of you who are newer to the community. But our goal is to help you get more diversification so you're building more resilient portfolios, right? And then what we've also done is, and so this is breaking news, this is new news, GW Capital Fund 1, we are, it's in the works. Within the next month, we should have that out. And the goal with the fund is basically, to allow all of you to have like a fund. It's not a blind fund. It's essentially a fund where you can go and you can pick whatever investments you want to have and how you want to personalize your portfolio. Because I strongly believe that it's not a one size fits all. That's going to be a big part of what we're doing with the fund. But also we want to be able to go in collectively and get preferential terms for our investors. So better returns than you would have if you went in as an individual, almost like a retail investor, right? So getting preferential terms for investors is going to be huge. We want to have some debt instruments in there. We want to have the ability to go in as private equity. So we're getting, especially in this environment, significantly higher returns, similar to what you get, with an equity position, but much lower risk because of where we are on the capital stack, right? So a lot of those things, and so that has been what has been propelling us towards, creating the fund. And so that's exciting. That's in the works. And I put this here just to show you. I know we talked about a deal in Dallas, which I was very excited about. And I was in Austin and Dallas doing due diligence on multiple properties, a few weeks ago. And what we've been doing with the underwriting, and this is true for all of you, right? As you are underwriting your deals, so as you're looking at deals that you want to get into for your own portfolios, this is going to be important, right? We always want to go into the right markets, right? Buying right is going to be a big part, where markets where there's good job growth, where the state is landlord friendly, the laws are landlord friendly, where there's a booming economy, right? So growth markets, the deal is going to be super important because, especially in the current environment, we really want to make sure we're going into deals that have significant cash flow going in, because that's going to be a buffer, right? And it's kind of really hard to see, which is why buying discounted deals, the right kind of deals with good cash flow is hard, but that's what we're focused on. Those are very important things. But our ability to hold on to the deals, especially in the current environment, a big part of that is going to be the kind of debt product that's on the deal. And then more importantly, what we've been focused on is the capitalization of the partners. How much liquid reserves do the partners have? How are they doing with the other deals that they are in? And what are the next few years going to look like for them, right? So are there any other holes in their bucket that they're trying to plug? That's a big part of what we're looking at also. And so a lot of the deals, well, the market's the easy part. We've already narrowed down which cities we want to be in, just based on demographics, and that's the easy part. We vetted multiple sponsors who are really excellent sponsors. Sometimes the deal isn't right, and for some of the sponsors, this is not the right time to partner with them, just because we want them to be more capitalized. We want them to stabilize the other assets in their portfolio. So we're being very strategic about these partnerships. And we do have a deal that we are getting into, the Villas at Sundance. Some of you may have seen the deal alert. If you haven't, go check it out. It's generationalwealthmd.com/Austin in lowercase. It's actually in New Braunfels, which is, so the last few years, I've been underwriting deals for my personal portfolio. New Braunfels and Dallas are the two markets that I've been hyper-focused on, right? And that's because I have multiple friends and partners who invested in the New Braunfels market, done really, really well. It's a hyper growth corridor with tons of jobs in there, job growth and population growth, right? More than, really like the numbers, it's probably in the top 3 fastest growing counties in the United States. So tons of growth happening over there. This is what we typically call, for those of you who were in Park 33 with us, this is a core plus asset. And I put this diagram here just to show this to you, because I know some of you are newer. So it's a newer asset, right? It's not your typical value add, which is an older, 20, 30-year-old apartment community. It's a newer, better looking, nicer community. It's almost like your flight to safety. And the advantage of going into deals like this is that there's definitely higher cash flow and lower risk, essentially, right? So it's leading more towards more cash flow, and it lowers the risk because of that. But given its location in that hyper growth corridor, that is where we're expecting to see, as interest rates drop and cap rate compression happens, and as the growth continues over there, we're expecting to see rents go up and demand increase over there. So very excited about this property. And then again, this is why one of the reasons we're creating the fund is because with this deal, this is the even with the Dallas deal we kind of had in the pipeline that didn't really materialize, we are now going in and we are negotiating significantly better returns for our investors. And so with this deal, all GW investors, if you were typically have been a Class B investor, you're now going in and you're getting reserve class returns. And I'll show you why that's significant. So if you go onto the page, generationalwealthmd.com/Austin, you will see this. Instead of getting what you would typically get in terms of average annualized return and your IRR, what you would get with a Class B investment. When you go in through the fund, which is what we're going to create, we're going to have that ready for you guys to invest in this deal. You're getting reserve class returns, right? So you're getting what someone who went in with a $500,000 check would essentially get. So we're able to negotiate better terms for investors. So I'm super excited about that. I think that's essentially what we want going forward for all of the deals that we're going to be entering. And so anyone interested in that, it's generationalwealthmd.com/Austin. Sign up for the webinar. The webinar is going to be next week. And I will talk about the deal a little more towards the end for those of you who are interested. But for us, and I want you to take pride in this, we have several hundred investors who invested with us. And then we have the Generational Wealth MD community, where we have our members who are in the coaching program. All of this allows us to support GW Gives, which is our charitable mission, and impact investing is a big part of what Generational Wealth MD stands for. So thank you for supporting this. In the last quarter, we've trained about 40 teachers in elementary schools, helping them cater better to the needs of children with special needs. We have provided thousands of dollars towards nasal cannulas for children who are suffering from respiratory tract infections in pediatric ICUs in southern India. All of that is part of the impact we're doing, and we're hoping to scale that. But I want you to take pride in it because it's not just about the investing part, right? We're hyper focused on impact investing. So thank you for being part of the community. Okay, so let's get into the agenda for today. We're going to start off with a deep dive into the economy. What's going on with the economy? Where is inflation? What are interest rates looking like? The good, bad, the ugly. Then we'll talk about multifamily fundamentals. And then we'll go quickly into the GW Capital portfolio, how things performed in Q1, and we'll have tons of time for Q&A. So, and then like I said, guys, just keep dropping your questions into the chat box, and we will get to all of your questions towards the end. Okay, so overall, I almost feel like this is something where we were expecting a recession. A lot of people were, but we're looking more at like a soft landing at this point. The economy is still strong. The GDP is still showing positive growth, because for a recession, you need 2 consecutive quarters of negative GDP growth. We're still seeing positive growth. The yield curve is still inverted, which means that, again, that is an indicator of a possible mild recession. So you'll still hear some economists say that we could potentially still see a mild recession between now and mid-year next year. But the good thing is that the Fed has paused interest rate hikes, and a big part of that is because inflation is under control. And we're expecting cuts. It seems like we're more likely going to have a few cuts before the end of the year. Not necessarily 3 cuts as they previously suggested, but we are expecting some cuts towards the end of the year, right? That's as far as the overall economy. As far as multifamily fundamentals go, the market is still relatively strong. Now, we have seen price drops in some markets, anywhere from 10 to 30%, depending on the markets. But everything considered, Q1 was definitely a better quarter because we did see rent growth in some markets for the first time, right, after a long time. Again, despite that, in many of the Sunbelt markets, we are seeing oversupply, especially in Dallas and Phoenix and Vegas. And what that means is that, rent growth this year may not be as good. We do expect to see positive rent growth this year, but we will see rent growth again going forward in a positive direction 2025 and 2026. Construction, and so there is a concern about oversupply in some of those key markets. And again, those are the really strong markets where there was a lot of migration, especially during the pandemic. That migration has slowed, but we don't have to be too concerned. It's a short-term trend. Construction financing, just because of costs being higher, insurance costs being higher, and financing in general being tighter, new constructions are decreasing. And so that it's going to be whatever we're seeing in terms of oversupply is a short-term trend, and there is going to be absorption. 2025, especially in 2026, the markets are going to start looking healthy again. Right. And then we do have a consistent long-term shortage in terms of housing that's likely to last the next 5 to 10 years. And so all of that necessarily supports really strong fundamentals for the multifamily market at this time. Right. We are seeing initial pre-distress in some markets, and a lot of this, and we'll discuss this later, a lot of this is deals that were acquired in the second half of 2021 and the first half of 2022, where there was variable rate debt in the equation. And so that's where the initial pre-distress is. We're seeing some distress. We are in a position to buy discounted deals, which is again great if you're someone who's looking to buy right now, right? And we'll talk about market psychology also. But for those of you who are new, and before we start deep diving into a lot of those trends that we talked about, if you are new to real estate investing, especially passive real estate investing, then this is a great resource, generationalwealthmd.com/guide. I want you to, download it. It's a quick read. I would say about an hour of focused reading. We go over how do you build your buy box. It's because real estate investing is very personal, right? So I want all of you to be very intentional about really building your buy box. How do you vet the market, right? How do you vet a deal? How do you vet a sponsor? What are the questions you need to be asking? How do you build your own due diligence checklist, right? All of those things are going to be super important. And so if you are looking for a good resource, that's a great resource. So make sure you check it out. Okay. Now, going into the specifics, right? Just wanted to, for those of you who are like me, data driven, I think it's important. And the thing with data is that it can always be presented differently. So let's go down to the basics. Let's talk about the data really quickly before we go into our portfolio performance. So like I said, GDP growth has been positive. There was a time in 2022 where it was negative. Everyone was really concerned about a recession. Since then, we've seen positive growth, which is a great thing. We're still in a prolonged yield curve inversion, which means short-term debt, the interest rates are higher than it is for long-term debt. And so that is still a little concerning. So we're likely close to the bottom of the cycle, but we're not necessarily trending upwards just yet. As far as unemployment has stayed pretty steady at about 3.8%. So that's a good thing, which again talks about the resilience of the economy overall. And as far as interest rates and inflation goes, all of you have seen this, right? Inflation peaked at about 9%, and then it started dropping. It's close to 3.4%. The Fed mandate is probably closer to 2%, which is why they aren't cutting rates just yet. Also because the economy is still strong, and unemployment is not as bad as they expected it would be. And so we're still holding in a holding pattern as far as interest rates are concerned. We may see one or two cuts towards the end of this year. That's what we're all hoping for. But again, our strategy has always been try to get into deals where if we had to hold it for the long term, we are in a position to do it, right? And that's where the debt part really comes in, our ability to hold on to the deals. And in real estate, and you've heard me say this multiple times, and you'll hear other people say this, a good deal over time becomes better, and a bad deal, if you give it time, it becomes good, right? So the ability to hold becomes critical, which is where getting the right kind of debt product is important. Again, as far as housing affordability, just with the way home prices are and interest rates are, it's still way more affordable to rent. And so that affordability gap is still there. But like I said, this is the first time in a long time that we've seen positive rent growth. And so that's again, not necessarily in all markets, but as a national trend, that is a positive sign. It's an indicator that we're close to the bottom and kind of on the way back up. Construction starts, like I said, starting to drop, which again means that the oversupply we're seeing in some markets, it's a short-term trend. As long as we have a longer-term plan, a longer-term horizon, we're going to do just fine. Overall, like I said, 2024, the prediction still is for positive rent growth, right? Same thing for the next few years. We're expecting positive rent growth. Occupancy growth, again, this is plateaued for a little bit, but those are still very healthy numbers compared to historic averages. Okay, so when we're looking to invest, and the question is, okay, what are the markets we're going into? We're looking for those big green dots, right? So where is population moving? Where's the most growth happening? So it is happening in Florida. It's happening in the Carolinas. It's happening in Texas. Atlanta is a market we're heavily invested in. Phoenix. So we're looking for those pockets. We're also looking for the places where the laws are landlord friendly. And so again, just this is another reason why we are heavily underwriting in Texas and even in North Carolina. At this point, we have a lot of acquisitions in Atlanta, Georgia. So it's all based on this, right? Very data driven. And I want you to focus on that as you're coming up with your own investment strategy. Okay. I mentioned this before. It's essentially what we've been saying for the last few quarters. Multifamily distress is going to be limited to, a few different areas, but what's going to affect most of you, and the thing that you need to take away, it's going to be those assets that were acquired in 2021 and 2022 with variable floating rates, which are shorter term, and that's where that distress is, right? And so as you're vetting deals that you go into, it's a good question to ask sponsors, how are those deals performing? What are you doing? How are you mitigating things? How are you de-risking things? How are you altering debt? Are you doing loan modifications, refinance? Good question to ask as you're having these conversations. Okay, so overall, let's talk about market cycles. Some of you may have seen this slide before, but for those of you who are seeing it for the first time, why are we talking about market cycles? Because a lot of investing, just because of we're very emotional as human beings, is based on market cycles, right? And market psychology. So I want you to take emotions out of the equation. So we'll talk about how we should be looking at these cycles, right? And this is, it repeats itself. So what have we learned? How do you take emotions out of it? And how do you make decisions based on where we are in the cycles? That's the important thing. So again, recovery and expansion, those are the phases where things are improving, right? In expansion, rents are increasing, occupancy is increasing, right? And asset values are also increasing. Then you get to this point where, you have the demand supply equilibrium, and then you go into the hyper supply phase where, things have peaked, right? That happened in, I would say that in this cycle, it was March 2022 was the peak of the market. And then rent growth is still positive, but it starts declining, right? And then occupancy is dropping over here. And this is where we are right now. We are in the phase, which is technically called a recession, right? So we have, at times when we have negative rent growth, right? This is where vacancy is the highest. And most of us believe we're like really close to the bottom over here. And then we're heading into recovery essentially, right? And so it's cyclical. And the important thing to remember is that this cycle, although it's kind of correlated to asset values, the important thing to remember is that asset values, multifamily pricing is always trending upwards, right? Because it's correlated with inflation. There are ups and downs, but it's always trending upwards. And I have more curves to, more graphs to show you that. But this cycle essentially is for cap rates, which is something that determines pricing for multifamily. And it's based on rent, right? Rent growth versus negative, rent growth positive versus negative, and also occupancy and vacancy, right? So that's what the cyclical nature is actually showing us. And, what you will remember from when we were at the peak, right, in March 2022, is that everybody had all these outsized returns and everyone was investing in deals with really compressed cap rates, which means they were willing to overpay for assets, right? And the general sentiment is very, very positive, but that's actually the time of maximum risk. Where we are in the market cycle right now, you'll see people are, especially if they're in deals that aren't performing well, there's fear, there's panic, and, there's anxiety. But this is also the time where we have maximum opportunity. The reason I'm mentioning this is because, again, you don't want to be emotionally driven as you're making these decisions. You want to be data driven, right? And so let's look at, this is what rents did in the United States, right? For, across multiple decades, right? And what you'll see is that rents don't necessarily drop like crazy. They may they will plateau. They may drop a little bit, usually within a 10% range. And that's true for the short-term rental space and long-term rentals, right? But they keep trending upwards because it's inflation correlated. Now, home prices, now this is what happened to home prices over multiple decades, right? Home prices will go, this is 07, 08. You'll see that it dropped, right? And so they will go up and down, but the general direction is always trending upwards because it's inflation correlated. Unlike the market cycle we saw before, where we're seeing that cyclical nature, that's for occupancy, that's for rent growth, that's for cap rates, right? Not necessarily for just home pricing in general. And you'll notice that over here, we're seeing a plateau because this is mostly single family data. But if you look at multifamily data, the forecast is that as interest rates start dropping, home prices, apartment prices will start heading up again, right? And that's where we are. We're potentially here in the cycle, and this is where we're headed. Same thing with rents. We did see a period where rents were flattening. Sometimes we had negative rent growth depending on the markets and the supply-demand mismatch over there. But the forecast for the next few years is, again, trending upward. And I think that's what I want you to keep in the back of your mind as you're assessing this data, right? And so, like I said, if you buy things in a neutral market and you expect to get a certain return, when you're buying discounted assets, right, when your purchase price is lower, and you're actually holding the asset like we do when we enter our deals for a 3 to 7 year hold period, then you're essentially getting outsized returns. And that's the part of the market cycle where we are. Most of the assets we've purchased in the last year, we've been getting them at close to a 10 to 20% discount, right? When you buy discounted assets, you're actually able to get outsized returns. And that's what you need to keep in the back of your mind. So remember where we are in the cycle. We're trying to not make emotional decisions. We're trying to make data-driven decisions. So I went back to these slides, and what I'm realizing is that, our criteria and what we're doing, how you should be looking at things as far as investing goes really hasn't changed much, right? It really doesn't change across cycles. Sometimes when we're in a buyer's market versus a seller's market, some of the criteria, you want to be more conservative. You're in a better position to negotiate and get discounted deals. That's the market we're in. You want to underwrite more conservatively, but otherwise it really hasn't changed much. So let's go over the highlights again. When you're buying, and I always say it's 3 things, right? How are you buying? Do you have the ability to hold? And what are the things that you're controlling, right? You're always buying in strong landlord-friendly markets. This is going to be really important going in now. You want to buy assets where you have positive cash flow day one. That is becoming more and more critical with conservative assumptions. Are you still in a positive cash flow scenario? That's what we're looking at, right? And then obviously the value add strategy, even in our Austin deal, although it's more a core plus asset that's higher on cash flow, we do have a value add component that we'll bring into play in the second year of acquisition. So that, that's again there. There are all the tax efficiencies where you're getting bonus depreciation, which is a paper loss that you're able to use to offset your cash flow. So your cash flow is essentially tax-free, right? Those are the important things that you need to know as an investor. How are you controlling returns, right? We're not just basing our investment strategy on where the market's going. How are we actually controlling returns? That's what we're doing. Buying discounted assets, that's again, buying right. And then the ability to hold again is cash reserves, which is why I said debt and capitalization. That gives us the ability to hold, right? The right debt, the having adequate reserve, we're holding 7 figures in reserves for GW Capital anytime we require that, right? We're very conservative in our underwriting. That's what we're looking at. And with our strategic partners, we're looking for those same things, right? Okay, so what are we doing differently in this market compared to before? Most of our debt is either assumable or we're getting fixed rate debt options. We will consider bridge debt if it's with the right partner who's executed the business plan. It makes sense for that. We aren't ruling it out completely, but most of the deals we're going into is going to be fixed debt, assumable loans. That's something that you need to really take a look at carefully, right? To make sure that the business plan and the debt really fits well together. We're purchasing assets at discounts. The deal in New Braunfels, it's $146K per door. And if we were to build something new over there, that would be $200 to $250K. So again, getting something that's discounted is like getting equity in the buy, right? That's critical. Lower loan to value that reduces your risk in the deal. In this particular deal, it's 66%. So only 66% of the deal is the mortgage. The rest of it is equity. And again, that's another way to make sure that the deal is conservative. And like I mentioned, higher cash flow day one. And going into more of those A minus, B plus assets, and that's a flight to safety, getting to those better assets, lower the risk in the portfolio overall, right? So anyway, so that's it. That hasn't changed much in the last few quarters. But for those of you listening for the first time, that's what we're looking at. And as you are vetting deals and vetting sponsors, I want to keep that in the back of your mind. I would say the two biggest points over there would be finding deals that have significant cash flow day one, because that's a good buffer. And then really taking a look at the debt, right? And then when I say debt, I also include the, if you are vetting other deals, check with the sponsor, see what their portfolios looks like right now, especially those deals in 2021 and 2022, which is where we're seeing the distress. So those would be two key takeaways for anyone underwriting, looking at multifamily, because even if you aren't underwriting yourself, if you're looking at multifamily deals to invest in passively, make sure that you're hyper-focused on those two things, but everything else that we discuss. Okay, guys. So moving into our, GW portfolio, Bronte East and West. This is in Mesa, Arizona. I was actually at the property in February, a few months ago. And this was, again, an off-market acquisition. We acquired this in July 2022, a few months after the peak of the market. Again, great location. And we've had 21% rent growth since we took over, so which is, again, good. We're executing the business plan. We've really bumped up NOI. And this was, again, a quarter where we saw rents rise, right? So again, that positive sign, that's another one of the indicators where we're at the bottom and kind of on the way up, right? That's a positive sign. The rent forecast for the market is, again, rents that are likely to trend upwards. Like I said, NOI growth of 22%, which is great. And then we have another target by the end of Q3 of boosting NOI by another 22%. In a lot of our deals, what you'll notice, and this is likely, most sophisticated sponsors are doing this, unless it makes absolute sense to go in and do a full platinum rehab, we've scaled back on the rehabs just to hold on to higher cash buffers. Sometimes it's a partial rehab, which is giving us a better ROI for the money we're putting in. And sometimes it's just doing a turn because we're not seeing those rent bumps, right? So depending on the market, we're altering our strategy, and you'll see most sponsors do this. And so again, the actual cost versus what was estimated, there's a significant saving over there. And all of this is data driven. Are we really getting those rent bumps? Now, this asset was purchased closer to the peak. I would say this is about where we purchased it, right? It was trending downwards. We did get it for a discount, but because interest rates were rising really rapidly in those 6 months, and there was oversupply in the Phoenix market, it was also a time where, because interest rates were going up, there was cap rate decompression. Values fell 25 to 30%. So, this asset, that was a challenge for this asset, although we've had significant NOI growth. The asset didn't necessarily have buffers for us to be able to buy the rate cap that expires mid-year this year. So in this particular deal, as the general partners ourselves, we have close to $2 million of our own capital in the deal. We haven't taken any asset management or construction management fees, right? Just to show you how aligned we are with our investors. And the other partners in the deal, they did go back to their investors and actually do a capital call, but GW Capital, we did not do a capital call. I wired in 6 figures of personal capital into the deal. That's how committed we are to make sure that we're able to hold on to these deals and preserve investor capital. We will be getting an 8% because it is a member loan. That's how we structured it. So, I loan personal capital to the deal. There's 8% interest that will be accrued, which will go back to our investors. And that's how we've structured it, right? And the goal over here has been to essentially, this is what the forecast is. We're over here right now. We're going to hold on to the deal and do an opportunistic refinance in 25 and 26. And we plan to sell the deal in hopefully in 28, right? As we're able to execute the business plan. So again, this is from when I visited the property. It's a great property, great location. Just a lot of factors that were outside our control, but we're doing everything we can to hold on to the asset and give it time while we're optimizing operations. Okay. Pelham Place, this is our asset in Greenville, South Carolina. Again, that's an emerging market that we went into. We acquired this also in 2022. I believe it was October, 281 units. And this one has fixed debt till I believe mid-2025, 65% LTV. So again, conservative debt terms. Another deal where we have over 7 figures of GP equity in the deal. The operations over here, the team has been really, really strong. Delinquency was super high when we acquired the property. They've been consistently maintaining it below 2%. This is an asset where, and again, this just shows you the power of what you can do with scale, right? Because with multifamily apartments, the asset value is dependent on the income that the asset is producing. When you're able to reduce expenses or increase your income, you're bumping up the value of the asset, right? So we had $45,000 in annual savings by executing the water conservation program, and in a sense that increased the asset value by almost $1 million, right? And that's factored in at a 5 cap. So that just goes to show you how powerful it can be when we make these small tweaks, and that's the value add strategy, right? When we talked about our overall strategy, the business plan is not necessarily just buying something and holding it and waiting for market prices to improve. It's about going in and really controlling the things that we can, which is value add. And oftentimes it's also, the tax efficiencies that you get. This particular property, just because of where we're keeping rents, we were able to get a tax abatement, which was a 61% savings. And so like I said, when you're reducing your expenses and increasing your income by even small amounts every year, you're increasing the property value significantly. So just a learning point over here. Again, NOI is trending in the right direction for this asset, and like I said, again, conserving our reserves, and so only doing minimal rehabs and really looking at those numbers to see what the ROI is for the rehab, and pivoting as we go. Again, this asset has fixed rate debt at a conservative loan to value till September 2025. So no issues over there. The goals for 2024 are again going to be to bump NOI. The problem with occupancy and delinquency is when you try to lower delinquency, it starts affecting occupancy also. So delinquency has been, the tenant base has been turned over effectively. The goal now with the leasing season is to just get occupancy higher. Again, Class A investors over here are getting full distribution. So this is, again, a deal kind of closer to mid-2022. And so as occupancy increases and as we're able to raise rents more effectively, we'll be able to resume distributions for Class B and C investors. And all deferred distributions are accrued, and you will get them towards towards when we have a capital event, essentially a sale or a refinance. Okay. Elevated Eagles Landing. I think we're going into our Atlanta portfolio at this point. Again, these are institutional quality assets. I believe this was an A- asset, 2006 built, so newer built, 10-year agency debt, 5.3%, tight rate cap over there. So again, very conservative debt terms. And like I said, whenever we do rehabs, we're looking to see, okay, what is the ROI for the capital we're placing? Anything above 15% is a good number. We're at 22.5% over here. Rents, we're hitting targeted rents. It's the second highest rent in the submarket. Delinquency has been lowering. Occupancy, we're maintaining it. Again, turning the tenant base and really trying to get things moving in the right direction. So the first 12 to 18 months after acquisition, it's just trying to get things in place and executing the business plan, doing the rehabs, and bumping up that NOI. Okay. Elevate Green McDonough's essentially a sister property. They were a 2-pack portfolio that was sold. We acquired them separately from the same seller. This is also an institutional quality asset. This was a loan assumption at 3.6%. This was acquired in March 2023, so interest rates had already spiked at that point. But we assumed the loan that the seller had, and so we were able to get in with favorable terms. Again, getting a 15% rent bump for the capital we're putting in for renovations, which is great. Q1, we did see occupancy grow by almost 4%, getting us into where we kind of want to be, above that 93% occupancy rate. Cash collections also increased in this quarter, so it was a good quarter for Elevate Green. I was at the property. I believe this was towards the early this year, and so again. The exterior renovations were in progress at the time. They're done at this point. So just stabilizing the property and bumping up NOI. Elevate Park 33, this is in Indiana. For those of you who were in that deal, the New Braunfels deal is very similar in that it's a core plus asset, right? So these are newer assets. This was a 2018 build. The new deal we currently have is a 2012 build. So newer assets, they're more cash flow heavy. So we're very pleased with the cash flow this is throwing out. Again, here we had another loan assumption. Like I said, the debt is going to be very important, right? So critical piece to look at for any deal that you're trying to get into for the next 12 to 18 months. And so this was another loan assumption. We got it at 3%. It's agency debt for 7 years. So ability to hold it for the long term, right? So it affects that hold component of your deal analysis, essentially. Again, it had the highest rent in the submarket. It's an A-class property. Occupancy, we're trying to get it to where it needs to be. With the leasing season, it's going to go up. Delinquency is again where we want it to be. And we did see a close to 10% NOI growth in Q1, all positive signs. Stewart's Mill was the last asset we got again in Georgia. The last asset we got we got it in Q4 of 2023. So we just got it in. For those of you who were in it, you obviously were able to benefit from the higher bonus depreciation we had last year. Now, bonus depreciation is phasing out. We have 60% bonus depreciation this year, unless they go back and they change the rules, but we're really not sure if that's necessarily going to happen this year. So we'll have to wait and see. But we still have 60% bonus depreciation. So that's another advantage of getting into deals this year. You're still able to tap into those paper losses and essentially use that, right? It becomes like a piece in your puzzle, and you're going to be strategic about it based on what your other passive income is, other deals that you're in, and you're able to use it to kind of offset your gains at sale, to offset depreciation recapture, or any taxes you may have to pay on other passive income, right? So again, it was great that we were able to close this the end of 2023, got it again at a 17% discount, fixed interest rate, agency debt, and we're still in the first few months of acquisition. So the first quarter is done, but we're just getting the tenant base to where it needs to be, cleaning up delinquency. Full distributions were sent out. So for anyone who has any questions about distribution amounts, please email us at admin@gwcapital.com if you have any questions. Everyone should have received their distributions. And if you haven't or are having any challenges, just let us know. Dawson Forest, this was our Q1 acquisition. And I was at the asset. It's actually a pocket, north of Atlanta, where there is tons of growth happening and really not a lot of supply. So one of those one-off pockets where there's not a lot of supply, but a lot of demand. So very pleased with this acquisition. This is a 98 build, again, institutional quality asset, and tons of growth happening over there. And I've actually visited that area over the last few years. So it's one of the fastest growing counties in Georgia. Again, it's like and with supply demand imbalance. So right, so we're still able to get those rent bumps even in the current environment. Anytime anybody renews or if there's a new tenant moving in there. So it's like almost a unique feature. It's kind of hard to find it, especially in the Atlanta area or near any strong metro, right? So this was a good acquisition. We have economies of scale there just because of our portfolio in Atlanta. And great debt. And like I said, these are going to be the critical things, right? Great debt on a fixed rate debt, and then significant cash flow day one. So those are important things. The first distribution for this asset, for those of you who are in Dawson Forest, will go out the first week of June. And for those of you who funded before closing, and you will be getting accrued interest, as well as you will get some prorated distribution for the first month of acquisition, which was a shorter month. So all of that's going to hit your bank accounts first week of June. And if you have any issues, let us know. Okay. Villas at Sundance, coming back to this. This is the opportunity we have right now. And like I said, I'm super excited because we were able to negotiate preferred returns for our investors. So all our investors are looking for. So if you're a Class A investor and you're trying to get into villas for Class A. So for those of you who don't know what Class A and Class B essentially is, Class A is when you're hyper-focused on cash flow today, right? This is for people who are more risk averse or closer to retirement or closer to cutting back on work, right? That cash flow today is really important to you. Anyone is interested in this for Class A. Class A is almost closing up. We just have a few spots left. So go ahead, go to generationalwealthmd.com/Austin, and there's a sign up for the webinar. But if you go below that, there's a soft commit button. Go ahead and soft commit for Class A, and you will get information on how you can go into the portal and sign up. If you're interested more in velocity of growth, right? So if you say you're the kind of investor, cash flow today isn't as important. I have 2 incomes coming in and I have another 10 years where I want to work. I'm more concerned about velocity of growth. Then you're looking at Class B typically. But what we've done for this deal is all our investors, you don't go into Class B, you go into Class C, which is preferred economics, right? Usually that's reserved for an investor who is coming in with a $500,000 check, but we're able to get it for everybody, who's a GW investor, who wants velocity of growth, right? So instead of Class B, you're getting Class C return. So what does that look like? I actually have some slides over here. But you're getting, instead of a 7% preferred return, 8% preferred return. And instead of a 70-30 profit share, where the passive investor gets 70%, you're getting an 80-20 split. So you're getting 80% of the profit share, right? After you're getting your preferred return. Your preferred return is essentially, if we have a liquidity event, then your investor capital is returned. You get about 8% for every year that you're in the deal, and that you're made whole for that first, before the profit is then split between the passive and the active investors. And the passive investor, and as a reserve class investor, you're getting 80-20, right? So it basically bumps up your IRR, it bumps up your average annualized return because you're getting preferred returns, right? And so it takes your equity multiple from 1.8 to 1.9. From 16%, you're going to an 18% average annualized return. So you're getting better economics. So if you are interested in Class B, if you go to the website, you will be able to sign up for the webinar. But if you go scroll down and you want to start soft committing, you can soft commit, but just wait for a few days. We're trying to get the fund set up, and that's what gives us the ability to get the enhanced economics. And so we'll send you information on how you can log in and invest via the fund. Now, so we'll have a deal webinar, and we're actually anticipating that sometime next week. So if you want to participate, learn more, if you're new or you're sophisticated and you have, nuanced questions, hop on the webinar and we can discuss more. Okay. What's great about this? It's again, an institutional quality asset. It's a newer build, so they look amazing. Class A asset, better, tenant base. It is new, like I said, New Braunfels and Dallas were the 2 markets that I was looking for my personal portfolio because it is a hyper growth market. And rents have been going up like crazy. There's a huge tourism there. That's hill country. Lots of tourism over there. Huge economic impact. And like I said, if you're going through the GW Capital Fund, you get enhanced economics. So anyone interested, go to generationalwealthmd.com/Austin. I'm almost ready to start taking those questions. But again, just to recap, guys, like I said, we've been hyper focused on picking the right markets. Keep your eyes open. If within the next few months, I think we may have another deal in Charlotte and hopefully one in Houston or Dallas. We're really seriously underwriting. We have strategic partners we'd love to partner with. We're just waiting for the right deals. But we're looking at the market. We're looking at the deal specifically, but also looking at, do we have the ability to hold on to these deals? And we're looking at debt and, the reserve status for all the partners in the deal. Okay. And we're looking at other asset classes, definitely looking at debt funds going in as preferred equity, where you're getting the same returns as you would in an equity position, but with significantly lower risk because of our position in the capital stack. We're looking at mobile home parks, short-term rental funds, ATMs, car washes. We're just trying to make sure we're doing our due diligence over there, partnering with the right people. But the goal is to get you those deals where you're getting higher cash flow maybe than you would see with multifamily. Sometimes you're getting more depreciation, right? So to keep your eyes open. We will have hopefully something very unique and interesting within the next few months. And then GW Capital Fund 1, super excited about that. That is what is going to give us the ability to, spread out into these different asset classes, but also get preferred terms for our investors. Okay, guys, that's it. Let's get to Q&A. And Adrian, if you could drop any questions that people have in the other platforms, that'll be super helpful. Hey, Alex. Hey, Blythe. Oh, nice to see you on here. Hey, Shalon.
Hi, Param.
Hey.
Can I ask a question since I'm driving and I cannot type in anything?
Go for it.
And I started late. So if someone wanted to make decision today about participating in one of those properties, what would be the shortest step? Or is there any person that we can consult with it?
Yeah, absolutely. Just shoot us an email, Alex, to actually there, if when you get the performance report, we have links for book a call. But if you're driving, I want to give you the simplest way to do it. So if you go to admin@gwcapital.com and just say, hey, I want to book a call and talk to one of you about this deal, that'll be the simplest thing. The other thing would be to go to generationalwealthmd.com/Austin in lowercase, and you can actually, if you scroll down, there's a book a call button over there, and then there's a soft commit. Where you can just click on it where it says soft commit, and it'll help you fill out information, and you can connect with us. But either of those things, if you want to just shoot us an email, admin@gwcapital.com, or go to generationalwealthmd.com/Austin in lowercase and find the button over there, or fill out the soft commit form, and we can reach out to you, Alex.
Thank you. Thank you so much.
Awesome. Okay. Let's see. Oh, thank you for dropping all of that in there, Adrian. Let's see. Okay. Hey, Ikta. Okay. So Radhika, so it's something that you need to keep applying for, but we were able to get that till the next time it's assessed. And I can't remember what it is like in South Carolina, but the assessment is different for different states. And so we were able to get that. It is not permanent, but it's not very short term either. So it's still the next time taxes get assessed. And again, like I was saying, that has a huge impact on NOI, net operating income, and therefore on the property value. Okay.
Thank you.
Sure. Oh, hey, Radhika. I was like, I wasn't sure which Radhika it was. This is nice. Radhika, the other question is the exit strategy in syndications. So there are two ways to get capital returned, right? Ideally, just because we're doing more value add deals, for most of the deals that we're getting into, and it works differently for different with different models. But our goal is to go and execute the business plan, do the rehabs, the value add, and then if we can sell the asset, if the timing is right, then the best thing is to sell so that we're able to, hopefully, in best case scenario, right, and across market cycles, on average, double investor capital in 5 years, right? So the exit is preferably a sale. Now, there will be times where if we sold the asset, we aren't going to hit the returns that we were anticipating. And if our debt term is coming to an end, we may need to do a refinance and put a different kind of debt in over there. And if we're able to return investor capital, you may have a partial liquidity event over there where you're able to, I believe I think it was McDonough, we may do a refinance because it was a loan assumption that's a shorter term. And if that's not the time we want to exit, then we may do a refinance. And there will be, I believe in that refinance, we built in return of capital of about 70% of investor capital coming back to investors. But the rest of the profits you will realize when sale happens, right? So it could be either a sale, which is preferable, which is what we like to do. But if market conditions aren't favorable, then it'll be a refinance. And that's when you'll get a bulk of the capital back and then the rest of it during sale. Radhika, does that kind of answer what you...
Yeah. I just wanted to know how liquid it is. So kind of explains. Okay, thank you.
Yeah, for sure. Hey, Annalisa, the upcoming acquisition in Charlotte. Yes, actually, we had a lot of interest in that market, and the partners we're working with are also vertically integrated there. We just want to, cross our T's and dot our I's over there. So we're still doing deep due diligence, and we'll keep you guys posted. Okay, awesome. Aiden, do we have questions from other platforms by any chance? If not, hi, Najib.
These are all the questions.
Excellent. Thank you. Nice to see everyone. I'm glad. Thank you, Indra, for staying on. But like I said, guys, any questions you have regarding deals that you're already in or deals that you want to go into, easiest way maybe to just shoot us an email, admin@gwcapital.com, and we're here to support you. Okay, I will let everyone go. I know schools are off in some places, and everyone is in vacation mode. So it's nice to connect with everyone. And we have another webinar. We have another webinar for the new deal next week. So for those of you interested, I'll see you then. Otherwise, I will. Everyone have a great beginning of your summer vacation.
Thank
Oh, hey,
you.
Joe. Sure. Joe, I just saw your question. A soft commit is non-binding, right? So what it does is it tells us that you're interested in the deal and it kind of holds your spot. It's almost like a placeholder. So if you went to generationalwealthmd.com/Austin, if you scroll through it, it'll first say register for the webinar, which is where we deep dive, we do a whole 1 hour webinar where we talk about the deal and the underwriting so you understand it better. But then you'll see a button on the bottom that says soft commit here. And if you click on it, it'll ask you to fill out a form. All it does is it gives us your information and it kind of lets us know that you're interested. So we kind of hold that spot for you. It's non-binding, but when we have the fund ready for you to start going in and signing the documents, we'll send you next steps. So it holds your spot and it lets us know that you're interested. And you usually will have a few weeks before we wait for you to get everything in order. But it's a placeholder essentially. I hope that helps.